Excellent. We are live. Good morning, everyone, for day 3 of the Boston Startup Week. If you were able to join us for the first 2 days, thank you so much. I hope you enjoyed some of those presentations and panels. If you weren't able to catch them, that's fine. We're going to have all that content recorded and be available to the public sometime in November. If this is your first time with us, just going to kind of walk through how to use this Goldcast platform. Right now, we are here for my apologies, the Startup Finance 101. If you're looking for any of the other panels that are happening at this exact time, please navigate to the tab that says Agenda in your top left corner, and you're able to jump into one of those other sessions. Today, I'm joined by Ted John Lowe, who's going to be running through a presentation on Startup Finance 101. If you have any questions for Ted, be sure to put them in the Q&A tab on the right. If you put a question in the chat area, don't worry, I will just nudge you to put those in the question and answer area. That way Ted can see them. And we should have a great presentation here. If Ted has any great comments or quotes that you really like, be sure to tag him in SBW Boston 2021 in LinkedIn or Twitter, wherever you want to post. We actually have a contest that those that pull the best quotes will be entered in to win 5 $100 gift cards to different Black-owned businesses across Boston. Without further ado, I'm going to hand it over to Ted. Ted, take it away.
Thanks very much, Brendan. Sorry, I just need to change my share here. There we go. All right, so this morning we're going to cover Startup Finance 101, understanding your basics on the way to profitability. We should be a pretty interactive session here, and if you have any questions, please feel free to chime in along the way. Hopefully we can be a little bit interactive. I'm not sure I have a full hour of content, but we'll see how it goes. So the first thing I want to cover when we get into, I'm just trying to figure out how to move myself forward here. As we get into startup finance is how do we build a profitable business, thinking about gross margin, thinking about creating efficiency and growth, thinking about how you manage administrative costs, how you manage burn rate and fundraising, right, which is a topic for all of us to deal with. And then like what happens when it goes wrong, because it definitely will go wrong at some point. Right. So gross margin is really the key to getting yourself on your way to profitability, right? And the way to think about gross margin is this is how you prove that you add value in the market, right? So this is the way that your business adds value, like how much you sell your product for minus how much you pay to build it, right? So how much does it cost for you to deliver your product or service, right? And gross margin reflects that value, right? Like how much value do you bring into the market? How much value are you adding over the thing that anybody else could buy in the marketplace? It's important when you think about this to include all of the costs of delivery, right? So I've seen a lot of businesses over time where people misunderestimate or misguess their gross margin based on what they think things cost, not based on what they actually cost. They exclude things like taxes or shipping costs or insurance. Credit card processing fees is another one that I think people commonly sort of leave out of the equation. And so I'm trying to think back to a good example here. I was consulting for a company a long time ago, made sort of an engineered stone product for countertops and tiles. The business was unprofitable and they really couldn't figure out why. It was unprofitable at sort of the operating expense line, and they just they felt like they had all their numbers in all the right places and they couldn't understand what was going on. And so this was a thing where they threw stones in the top. They had this big machine. They threw stone in the top of the machine. It crushed the rock. It basically glued it all back together into tile and countertop. And out the other side came this beautiful engineered stone countertop. And they said, the really amazing thing about our process is that we have no waste, right? Because the first place we looked was we said, well, do you have a yield problem in terms of how much stone it takes for you to produce, a single piece of countertop? I said, no, it's amazing. This is a process where we have no waste because anytime we have something come out the bottom that is imperfect, right? Like anytime something doesn't work, we just throw it back in the top, recrush it, and it comes out the bottom again. And the whole machine, it was a sort of a room-sized machine. It used a ton of electricity in the sort of chop up, crush of the stone, and then curing the epoxy that sort of held the whole thing together in the end. And we said, okay, well, that's interesting. So you don't have a yield problem. But like, let's think about this, because when we're on the factory floor, we can see that like there's a lot of imperfect stuff that's going back into the hopper. And they say, oh yeah, actually, only about 1 in 10 tries does it come out perfect enough for us to sort of accept it and approve it. So what was happening was they actually were doing all their gross margin calculations, assuming that on the sort of marginal unit of running everything through the machine once, but they actually had to run the machine like 10 times to get the thing out on the other end to the quality that they found acceptable. So they had this gross margin, which was great. And then you get into their G&A costs and you say like, their CFO's like, I don't understand why our electricity is so expensive. And it turns out they were losing money because they were running the machine over and over and over again, and running up their electric bill, not counting that as part of their gross margin because it was just electricity. And it was actually the thing that was dragging the company down overall. So the important thing here is like, when you're thinking about the gross margin of your product, right, what it costs you to deliver the thing, include every single cost every time, right? So that is an absolutely critical component, and it's a thing that normal accounting doesn't necessarily reconcile with, right? So there are G&A costs, in my example, sort of the electricity costs that go along with delivering your product sometimes. And it's important to understand what those costs are and include every single one of them every single time, right? If you don't do that, you're just setting yourself up for disappointment in the end. We got to bounce back here now. There we go. So if we include every single cost, like that's the sort of best path forward on figuring out your gross margin. Should have done this with 2 monitors, but here we go. So the next question, and this is sort of a popular place in the startup world right now, is like, well, I did my gross margin and like it's negative. Like, what do we do now? Because that effectively means I'm paying people to use my product, which feels like probably not the best business plan in the world, right? It's actually not an impossible strategy to pursue, right? And a lot of companies have done it, right? Amazon did this, Zappos. So early days of Zappos, they carried no inventory, right? They had all these shoes on their website. They carried no inventory. When they got an order, Zappos is based in Vegas, they would literally send somebody to the mall to buy the shoes that had been ordered. They would buy them at the store, run them back to Zappos, ship them out, and do the whole thing, right? So this was part of their strategy to figure out if the thing worked, and build it out and go from there. So it's certainly possible to run at a negative gross margin, but you really have to understand why you're doing it, right? Amazon's done it, Uber and Lyft. I think right now we're seeing sort of the snapback on that, where we're actually paying real prices for Uber and Lyft for the first time in their history, and it's a little bit weird. And last but not least, right, our company ConnectRN ran a negative gross margin for about 18 months as an early startup. So it's certainly something you can do, but if you're going to do it, right, this is the place where you have to understand all your costs. You have to understand why you're doing it. And you have to be fully bought in on your willingness to go there. Right. And the question is like, why are you doing this gross margin thing? Right. And there are 2 big reasons. Right. One is price experimentation. Right. So you're trying to figure out, and this was our case at ConnectRN. It's like, does the technology work? Can we actually, we just need sort of users to try to see if the tech itself actually works. And effectively, we were paying our early users to help us test the system. Right. So that's one reason you might lower price. Another is that you want to create a market where one doesn't exist. Right. And this is sort of the Uber, DoorDash, even Amazon model, where they basically said, we're going to underprice our thing for a little while, make people totally dependent on it, maybe put legacy cab companies out of business in the case of Uber and Lyft, and then we'll raise our prices later when we can, right? The challenge of that one is, just to be transparent for everybody, that requires massive buy-in and huge amounts of capital, right? Which obviously the Ubers, Lyfts, and Amazons of the world were able to raise. But it is a strategy that requires you to know upfront that you're going to be able to raise a huge amount of money. And then the other part of it is, like, you're small, you're a startup, like, there are things you don't know, right? There are parts of your process that you just have to believe, and this is part of startup life, you just have to believe you're going to get better at, right? So these are the miracles that occur in startups where, like, most of how you're going to accomplish what you're going to accomplish. But you might say, look, we know we have to scale this process. We know we have to figure it out. We know right now that we don't know how we're going to figure it out, right? Part of the bet that we're making is that our team, which is amazing, is going to figure out how to do this better and cheaper than anybody else has, right? And the other side of it is, for those things that are knowable, like, what costs are going to decline with time, volume, or knowledge, right? So there are certain bets about life that we're willing to make. If you think about, if you had a software product that was particularly computationally expensive, and you needed to go buy the most expensive chips in the world to make it work, I'd be willing to make that bet, because the pace of innovation in sort of chip technology is such that what's impossible today or what's very expensive today is likely to be pretty reasonable in 12 to 18 months. So, you understand what that timeline is. There will be places where, you're going to get a volume discount. You're buying something right now, on a onesie twosie basis, but when you're buying thousands of them, the volume discount is going to come through. And then there's a set of things where, like, you're going to learn, you're going to get better, and you're willing to make that bet. The question for startups and for startup investors is, like, these sort of miracles of mystery, right? The moments where we don't know what's going to happen next. And we need to make a bet on ourselves and our team about, we're not sure how we're going to reduce this cost. We're not sure how we're going to increase that price. As I said, it's okay to have those in there, right? It's okay to not know. That's actually sort of the joy and mystery of startups. When you stack too many miracles on top of each other, right? And there are too many places where, we don't know this, we don't know this, we don't know this, we don't know this, but we think we're going to sort of knock all of them out of the park. That's where I think you have to look at yourself in the mirror, and that's where investors are going to get pretty skeptical about your ability to deliver. Everybody expects you to deliver at least one miracle, because that's what we do here. But the question is, how many can you stack on top of each other? All right. Efficiency of growth. Actually, I want to go back and see if anybody has questions on gross margin, right? So gross margin is, to me, the crux of how good is your business, right? How strong are you at what you do? How much more are you able to charge for it than somebody else, right? Questions, comments? No, we're just going to plow right ahead here. Not going to make the whole hour. That's okay. The other big one to me in terms of startup growth is understanding where and how you scale the growth function, right? So there are two things that you have to focus on early to get yourself from sort of 0 to 100. And, one of them is obviously building a world-class product that creates gross margin, right? That people love, and you can sort of demonstrate that you've created value in the world. The other piece of that is how fast can you sell it, right? How fast can you make that product adopted in the market? Because if you can only, if you build a great product and you can't effectively sell it, you really haven't achieved anything. One of the key learnings for me in doing this has been, that sales is a place where you think how you sell and how efficiently you sell, how fast you build your sales team is what limits your growth, right? You think that's true, but churn is really what limits your growth, right? So it's actually not how fast you gain customers that decides how fast you can grow and how big a business you can build. It's how fast you lose customers, right? And that is highly counterintuitive to people, but it's really just math, right? So there's a terminal velocity in growth, right? I firmly believe this. I've seen this in every market I've ever operated in, right? So for a given market size and a given sort of limit on client acquisition cost on CAC, so you say like the most we could spend on CAC is $200 a customer, $400 a customer, whatever that might be. In some cases, it's a lot more than that. And whatever set of acquisition strategies and tactics you have, right? With those three givens, those three constants, there are only so many customers that you can pull out of the market and into a contract in any given period, right? And it's sort of an immovable object. And you have to believe, again, like this is what do you have to believe for your startup to be successful, right? Obviously, you've done the work on market size. Obviously, you understand your CAC to LTV sort of big picture ratios, so you know what you can spend there. And you have to believe on acquisition strategies and tactics that you're doing the best you can, right? Like, it's ridiculous to say we're going to continue to grow faster because like we're really bad at this and we're going to get better at it, right? You have to believe that you're doing the best you can. So with those three constraints, you're going to have a fixed output of number of new customers every quarter, right? And that ultimately means if you believe that's true, that ultimately believes or creates a circumstance where the biggest your company can ever be is the number of clients who you can acquire at that terminal velocity divided by your attrition rate, right? So if you can bring on 100 clients a month, let me try to do this math in my head. Bring on 100 clients a month, but you lose 10% of them a year, right? You're only ever going to get to your business is going to max out at 1,000 clients, no matter what you do. Because when you get to 1,000 clients, you're going to lose 100 of them every month, and that's as fast as you can bring new ones on, right? So the way that you can actually grow your business and grow your business much faster is not by optimizing for growth. It's by optimizing for attrition, right? And there are some attrition things that are also immovable objects. So when I was at Athena Health, I don't know, 5-10 years ago, we had this situation where we had exceptionally low attrition, right? It was an amazing product. But our attrition rate was really stuck at about 8%, and we could not move it. It just, everything we did, we'd fluctuate between 8 and 10% in the small groups position space. And we just, we had a really hard time with it, and we tried to move it and tried to move it. And then eventually we thought about what was going on, and we realized that, sort of 10% attrition implied that you had a customer for 10 years. So that was an annual attrition number. You had a customer for 10 years, 8% attrition that you had a customer for 12 years. And if you thought about who our clients were, these were mostly sort of small practice doctors who were opening their own practices when they were sort of in their 40s, right? They went through med school in their late 20s. They did their residency. They worked for somebody else, opened their own practice when they were in their early 40s. And we realized that actually, 12 years represented sort of the average length of a career, right? And what we were seeing in our churn was not clients who were dissatisfied. It was clients who were retiring. And there was really nothing we could do about that, right? So that was one of those things where, that was ultimately a governor on the ultimate size that our business could be, was that we were losing clients because they literally were leaving, we're leaving practice and leaving our market size altogether. Any questions about that as a concept? Allison's asked, at what point do founders realistically need to consider bringing on a full-time CFO or at least a fractional CFO hire? That is a good question, which I'll cover in just a second. So here we are, administrative costs. Like, what do you really need? What do you really need? And to Allison's question, it depends, right? So focus on what you really need and outsource wherever possible, right? Because admin costs are ultimately the thing that you can't manage. Dana, I'll circle back to you in a sec. So on the CFO question, right? Like, if you have a financial model, as we did at Connect RN, just to be transparent, right? Or as anybody running a negative gross margin, like, you're going to want a fractional CFO or a full-time CFO as soon as possible, because understanding the finance at a very, 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 very granular level is going to be key to your success or failure. If you're running a SaaS business or a software business, or a sort of normal app-based business, CFO is not that necessary, right? The financial constraints are just different. It's much easier to plan. There are far fewer sort of things that need to go right in the financial picture for it to make sense. Dana asked, should you account for attrition in financial projections? And if yes, at the pre-seed round, what's a reasonable attrition rate, since we have no idea? I think early on, you absolutely have to account for attrition somewhere in the model, right? That has to be part of your LTV theory. I think in a pre-seed business, you got to look at peers. You have to think about what other companies like yours look like from an attrition perspective. Obviously, you think that you're going to be better than everything else on the market. That's why you're doing what you're doing. But the question is, how much better will you be? How much lower can your attrition be? I think in a SaaS kind of business or a software kind of business, you want it to be relatively low, certainly less than 20% a year. And then from a transaction business, it's much harder, right? So a business like retail or otherwise, same store sales is really can be the entire model, and you have to focus a lot on that. So Benjamin asks, you say there are two strategies to launch SaaS, gain loads of traction, even if that isn't revenue generating, right? So that's mass adoption, or gain a small number of clients, treat them like gold, upsell them, and scale outward. So I think those are two interesting questions, and actually a lot of it depends on, on your sort of financing strategy, et cetera, right? So if you own the business outright, and I've done this sort of both ways now. So early on in my career, I ran a startup that was bootstrapped by the founding team, and we pursued strategy number 2, which was get a small number of clients, get yourself to cash flow profitability quickly, and run like a disciplined business. So we had a business that, we launched and then got to cash flow profitability in about 24 months. And, we were dropping 50% EBITDA margins on, I don't know, $12 million of revenue in year 3, right? Which was amazing. It was a great outcome for the founding team. But the business ultimately didn't grow to be huge. It was a profitable, great business for that team. In a venture-backed world, the venture investors are almost always going to advocate for sort of path 1, which is make yourself as big as possible, as fast as possible, try to own the market, figure out the ultimate profitability later, right? The caveat to that being, you do have to sort of be really crisp on the gross margin topic, right? So if you're, and we've seen a lot of sort of unicorns right now running businesses where, they're expanding their top lines in enormous ways. Some of them have actually pretty decent gross margin unit economics, but their cost of acquisition and costs of the internal business, product development, et cetera, are just massive, right? So contribution margin's okay, but at the bottom line, they're losing tens or maybe even hundreds of millions of dollars a quarter. And that's actually not an unrealistic strategy. I would say as a startup founder, it's a lot to think that you're going to be able to accomplish that. That requires very committed financing sources, as some of these firms have. But it's certainly possible. And the question is, like, if you have something that works on the unit basis and you're just spending a ton of money on, PR and Super Bowl commercials, like, That's okay, because once everybody knows your brand and loves your brand, you don't have to spend as much on the Super Bowl commercial, right? So that hopefully all lines up. So if we think about the administrative costs, I'm a huge advocate for outsourcing costs on the administrative side early, right? And the reason is that there are very few startups where you have the scale that you're going to be able to pay for and sort of gain value out of, out of the team that you hire, right? So CFO, controller, bookkeeper, all those people, if you can outsource those functions, it's going to look on an hourly basis kind of expensive, right? You're going to look at it and say, geez, like, why would I pay a CFO, outsource CFO, the equivalent of $400,000 a year if I sort of do that hourly math out, when I could hire one for less than that? And the answer is because you actually only need that person for 5 hours a week, and the overall expense is lower and the quality is probably higher, right? So you're much better off, in my view, especially early, paying a lot for the best advice you can get, legal, finance, accounting, HR. Do that with contractors. It gives you flexibility. Again, like if you've outsourced these functions and you have to cut those expenses back, that's a lot easier than laying off or reducing your team because you just don't have the volume to support it. So you really have to be careful as you grow into those places. But it's one of those things where all the way through you'll get pressure from people who will say, we could hire a a finance person, or an in-house counsel would be a lot cheaper than having outside counsel review all these contracts and do all the stuff that we have them doing. And it's like, that's true, but one, there's a quality differential, and two, there's optionality, right? As long as you have contractors, you, for the most part, get to choose who you spend your money on and who you don't. Once you've taken on an employee, assuming that you're a sort of decent and reasonable employer, like you've made a real commitment there. You've got to hold that person in. You've got to do the right things for them. You've got to build their career. And that's just a lot for a company that has probably a lot of other things on their plates. The question of what shouldn't be outsourced, what should be, what should be done internally. I think the outsourcing and what gets done internally has a lot to do with what the founding team looks like, what the founding team is good at. I think that building HR and culture early is an investment that you really have to make. If you, ideally the founding team sort of has a lot of that in their DNA. But if you don't, I think you need to get an HR leader who can help you bring that together, because that's really critically important. I think in the current COVID world of remoteness, that's going to be an all new job and all new specialty, is figuring out how to build startup culture on a work from home or work from wherever we're working from basis. So that's the one that I think would be a pretty early hire in my view. Things like finance, legal, payroll, I would outsource all those things as long as possible, honestly. Except, unless you have a real business reason to do it. So at ConnectRN, payroll is a huge part of our business, and as a result, we've insourced it from really day one. But in a lot of places, it's a G&A function that should just be with somebody else. Just running through the questions. Sorry. So a question of, how might a VC look at a business with key functions outsourced? I think that, this is all about the founding team creating the most value they can. And I would far prefer a business where a key function was outsourced to an expert, instead of, we hired the person we could afford who's sort of average, right? So you really need to do your best to assemble an A team by the same token, if you have an opportunity, I would say, to hire somebody who's amazing in a role that you think you're going to need, always hire that person, right? Always. So if the flip side to outsourcing is anytime you have an opportunity to make an amazing hire on your team, like you have to do that. You just have to, even if that means that, you're bringing that person in and it's going to be hard. If they're truly amazing, it's going to be worth it. All right, let's get back to PowerPoint. Managing burn rate. So one of my favorite topics. Obviously, we're all startups here, which means that we're mostly burning money. You turning the corner to profitability is a big moment, but as a founder, CEO, CFO, sort of leader in a startup, the most important thing about burn rate is like just get used to it, right? Like it's stressful. I was talking to a peer 2 weekends ago, and one of her views was that and she's in a very well-funded, pretty big startup, and she said, "Look, the biggest stress I have in my life is managing the burn rate and wondering when it's going to end." Right, and you have to really focus on not letting that burn rate sort of consume your every waking hour, because it's stressful to know how much cash you have. So a lot of what I'm going to talk about in managing the burn rate is I would say more in managing founder CEO stress, right? The burn rate is the burn rate. The question is like, how do you sleep at night when you're burning $1 million a month or more, right? And it can be a challenge. But the way you do it is, the way I did it is get really granular, right? Get super duper duper granular, right? Understand the cadence of your expenses, understand what expenses you have daily, weekly, monthly, quarterly, annually, right? So, even right now, I can tell you, I'm sorry to say, like pretty much to the penny what all of our weekly expenses are. We're not burning cash anymore, but we certainly keep an eye on what's going on. So it's super important to understand payroll is typically weekly or biweekly. Like, what's that cost? When does it hit? When do you get paid? So, if you get, if you're using a lockbox that sweeps, like when does your cash come in? When does it go out? What are the high points? What are the low points? What are the expenses you have every month? Rent is typically the big one, though I guess that's changing in the new world order. And then you don't want to be surprised by quarterly or annual payments, right? So there are some things, I'll just be honest with you guys. Every quarter when I send a check to Salesforce, I'm sort of blown away at how expensive that is. And early on, like that was a huge expense for our company on a proportional basis. It was worth it. We run a huge amount of our company on Salesforce, but that was an expense that we had to plan for. It came every quarter, and it wasn't something we could afford to do without. There are other annual expenses like liability insurance or other things that can really, if you're not expecting and planning on a bill that could be tens of thousands of dollars, could be hundreds of thousands of dollars, that is a tough surprise. So the way that I've always felt about managing burn is just get really, really, really granular on knowing what to expect from a cost perspective, knowing where they're going to be, and and what that's going to look like. Then, if you do really know all that stuff, you really know it cold, you know what your runway is, right? And you know how long you have at your current revenue, current gross margin rate. You know where you need to go, and you can plot a path forward. That moment where you feel like you have, I would say, 6 months of runway left, right? And in any startup, in my view, 6 months is like, it feels like a lifetime. It's not. If you have 6 months of cash left, it might feel like you got all the time in the world. You need to be fundraising like yesterday, or you need to be figuring out what comes next yesterday. even if you have an investor base who you think is rock solid, like 6 months out, start talking to them about, what milestones you need to hit, when you need to do the next round, how that's going to go, because that is absolutely critical to managing your own stress level, right? And honestly, like being really crisp on what the costs are and where they can go is the only way to do it in my book. And if you do really understand it, you can run a pretty tight ship. So, in my lifetime, I think I've run startups down to just about zero cash, right? To the point where our deposit sweep was basically coming in on Tuesday and we were funding payroll on Wednesday. Like, it happens. As long as you know what you're doing, it's not the end of the world. And as long as you know where your funding is coming from, you can pull it off. But you really have to understand every single number for that to work. And I actually don't recommend it. That's probably the most stressful time. And then the last piece is, again, like, understand your vendors, right? So understand your expenses. There are things like payroll. You cannot miss payroll. You just can't. Like, that is the end of the world and sort of the end of your existence as a founder and as a company. The second category is you can't miss payroll taxes and other taxes, right? Because the government actually will come after you personally for them. So, those are the two categories. You just got to make sure you always have enough to fund. You've always got to do the right thing. You've always got to be ready to wind down on payroll. Other things like, look, if a business fails and you owe Salesforce.com $50,000, like, I'm sure Mark Benioff is going to be okay, right? Like, that'll be fine. You owe your landlord money, like, I'm sorry to our landlord, but like, they probably have a security deposit anyways. Like, this is a tough situation at the end, and you've got to come out of it sort of prioritizing the people that you care about, who first should be your employees and people who really have helped the business. And at the end of that list are the big vendors who, look, let's be reasonable. I've been on that side of the table too. Look, they have a bad debt assumption. They know some people are going to not pay their bills. Some people are going to fail. And that was a risk that they took in doing business. I think the other part of this that everybody's got to remember, which is really, really hard, is I know everybody here has been successful in their careers, right? That's why it's one of the things that gives you confidence to go out and do this on your own or with a team. It's the success that you've had. And failure to you feels like the end, right? It's something that you haven't experienced a lot in your life, probably. And the interesting thing from my perspective with the experiences I've had is you're the only one who doesn't expect you to fail, right? So, like, everybody expects you to fail. So you come into this model feeling like you've let everybody down. Really, it's only yourself. Everybody expected you to fail, right? Which is sort of insanity, but it's just math. 90% of startups fail. 60% of A-round finance startups fail. Like, it's okay. It's not the end of the world. What matters is like how you do it, right? And how you treat people in that time, which is candidly like a really hard time in your life. But the question is, how did you manage that with everybody else? And if you did it well and you did it sort of in a way that didn't burn any bridges, nobody's going to feel bad, and you'll get another chance. So that's the important thing to remember is, sort of manage your finances, manage the burn, understand who the important people to pay are, and who the people are who, it's a write-off for them. They understand it. It's just a cost of doing their business as well. I think that's all I have. So any more questions? Anything I can cover? So the question, what if you have a digital coaching business that you build without any investments from outside loans, and now you're ready to seek funding? how do you think one goes about that as a new business? Look, I mean, I think that having metrics around your business, the best startups are the ones, in my view, that have a track record before they go out for funding, right? So you can demonstrate product market fit, you can demonstrate gross margin, you can demonstrate growth plan, and you have a way to do it. Those are the businesses that are likely to get funded, right? We hear a lot, because it's popular in the press, about VCs that are doing seed or pre-seed rounds before, when a thing is just a concept. The reality is that those businesses are exceptionally rare compared to the ones where, the founder put everything in and just did the best they could, and then actually proved out something along the end. And I mean, I'll tell you, we've certainly experienced it here. I've experienced it throughout my career. The most frustrating piece of this all, I'm sure you've heard it before, is when you really need money, it's really hard to get. And when you really don't need money, a whole bunch of people are willing to fund you. So if you can bring a business to the place where you can say, look, this is sustainable, these are the metrics. If I had an investment, I could grow it 100 times bigger. But if I don't have an investment, it's going to be okay. That's the place of leverage and the place where you're going to be the most successful. I got questions coming too fast. Sorry, guys. Once you're at operational break even or just started to become profitable, how do you decide whether or not to fundraise to accelerate growth? Right. And so that's another sort of good one, is you got to prioritize between growth and scale. And I've done this, as I said, in two ways, right? So I worked in this bootstrap startup, and our focus was on, generating a great business. 50% EBITDA margins and a lot of cash were more important to us than 100% growth. In the business we're in right now, look, we're growing 4 or 5x year over year, and our investors and our sort of management team is in the opinion that we'd rather invest every dollar in continuing that growth in exchange, as opposed to creating earnings. And it's all about what you think the opportunity is, what you think the future is, and what you think your outcome is. Sort of most common finance 101 mistakes made. I think the easiest one is not fully accounting for your costs, right? The easiest one is thinking because you're going to pay somebody $50,000 a year that it's going to cost you $50,000 a year to employ that person, when you haven't accounted for, the payroll taxes that you have to pay on it, the health insurance cost, everything else. And that person who you just offered a $50,000 salary to, you suddenly realize costs you more like $80,000 a year, and you can't figure out what just happened there, right? So I think that's probably the biggest early mistake. Sorry, just scrolling through some questions here. I think that's all we got. Any new questions? Access to slides? I think so. What line items should be in financial projections versus due diligence financials? So that's a good question. I think so. My view of diligence and of financial statements is investors generally, and assuming you have nothing to hide, which I hope you don't, be as open as you can in the diligence process. Investors appreciate it. Give as much data as you can in every way. I think that the one key difference is the operating metrics that you look at. You also want those to be in your diligence package, right? Because assuming the investor comes in and does invest, you want them to understand how you look at your business. You don't want them to come in with a new view and say like, oh, well, we took your financial statements from your data room and this is how we look at your business, right? Because that actually can ultimately end up driving how you think about it. And really you want to be the person dictating to them, because presumably you're the expert on how you should be thinking about the business, how you should be thinking about financials. And one place to do that and get an early start is to give them that guidance in the diligence work. So when you set out and plan a budget for operational expenses and marketing and sales, do you take raw numbers and add 20%, focus on CAC? Basically, how do you, sorry, I have to read more. How much money do you need to survive and make the business work? Yeah, I mean, look, so I think that's a question of burn, right? Is how much do you need on top of, so once you've delivered your gross margin, once you've got your CAC, like how much do you need left over? And I could show you a deck from the early days of ConnectRN, which I actually looked at last night, where, I showed the management team, like, look, this place that we are right now is unsustainable. And no matter how fast we grow, if these are our ratios, we're still going to be dead, right? So these are the ratios we need to focus on. These are the costs we need to bring down and bring everything into line. And, it took us a little while, but we got there. So Chuck asks, how granular do you have to be in your costs and in your model? I probably agree with your bank. I think that on the revenue model side, be as granular as you can, right? Be super granular in terms of understanding your market, understanding your customers, understanding their buying patterns. On the expense side, you don't need to be that granular, and you also don't want to lose some flexibility, right? One of the nightmares in dealing with investors can be, you need flexibility to make trade-offs in your expense base. And it's really no fun to be, to be under your expenses overall and have an investor or a bank or someone else say like, yeah, I mean, you beat your number overall, but, why was this expense so high and this expense so low, right? I think you're better off, running more generalities and giving yourself more flexibility. And that's important because, one of the things about startups that everybody just has to reconcile is there is a lot we just don't know, right? Like that's the whole point. There's a lot of this that even with all the experience and everything we've done in our lives, you just don't know. And you need flexibility to adjust the business on the fly. And the more detail you've put into your plans that you've committed to, the harder it is to make those adjustments as you go. Email the slide deck. You can email me anytime, tjeanlo@connectrn.com. I'm really easy to get, but otherwise, happy to connect with anybody. I think that's all of our questions. That's not all of our questions. Advice when you make a pivot, when the market starts not buying not your original idea. You've always got to be ready to pivot. I've actually never, so this is sort of my third real startup-y thing. And every one of those businesses had a significant pivot at some point in its trajectory, right? So I would be fascinated to know if there is a successful startup in the world that's actually prosecuting like the very first idea they had, right? So, Athena Health, where I was for a long time, started as a women's health clinic, pivoted into being a software business, right? This business started as a software business. We pivoted into being a services business. It's all about finding product market fit, doing it fast, and being willing to make those changes, right? And being willing to know sort of when to make the pivot and when not to make the pivot. If your startup is based on municipality and landlords purchasing your data from a SaaS and a data team working with that municipality, should employees be contracted until sales are garnered? I think that, yeah, I mean, anytime you can use contractors instead of employees, I think that is, that's to your benefit early, right? It gives you flexibility. It also gives everybody a reasonable understanding of the risk levels, et cetera. The only thing I would say is that when you're in that last moment of, winding down and deciding who to pay and who not to pay, think about those small contractors, those 1099s. You got to think about them like employees because they need, they did not have a bad debt reserve. They're expecting to be paid, and you need to take care of them just like you would an employee. But otherwise, I think having contractors gives you a lot of flexibility. Question from Dana is a good way to understand churn is to look at competitors in the market. Where does somebody find that data? So if you have access to sort of Wall Street analyst reports, that's actually a pretty good place. There's a lot of bad information in those reports, but there's also a lot of good information. So if you can find a publicly traded peer, right, and you can say, here's a company that is 10 years down the road of what we want to do, and they're achieving a churn rate of X. We think we can do better than that for these 5 reasons. I think that's a good place to start. Other places to understand churn. So there are analyst reports. There are, sort of press reports. People brag about their churn data from time to time. Another place that I find to be a sneaky good source of information is actually in job descriptions and job recs that are posted on their websites, right? So you'll see if you're looking for churn data, hey, maybe there's a director of customer success role posted on their website, and somewhere in the copy it says, manage our churn rate down from X to Y, right, as a responsibility. So I find those to be sort of sneaky good places to find intelligence. Employee hire to churn ratio, good rule of thumb, scaling from 2 to 10 employees or more. I'm not sure if you mean employee churn or business churn. I think that employee churn right now is crazy. We have no idea what's going to happen with sort of return to work, whatever that means, and how that's going to appear. I think that you've got to build out a business that's sort of sustainable and in a model that works. I think churn could actually be, again, it could be a thing where churn could be high, just like gross margin could be negative. If you know that you're doing that and you sort of understand how you're going to get it under control moving forward. So I think there's no hard rule on that. All right, 8:52. We ready to wrap this up? Thanks, everyone. Appreciate your time this morning. Let's get back to work.
Well, I just want to thank you, Ted. As a quick question that came through, what's some of the best ways that some people can reach out to you? You mentioned your email, but maybe LinkedIn or anything else, other forms?
Email, LinkedIn. I'm easy to find. So when you have a really complicated last name, it turns out you're really easy to find. It's like
Excellent.
one of the joys of it.
Well, thank you so much, Ted. For those of you that are still listening, we will find out, as some of you have asked about getting some of the slides. Our operations team is working on that to see if they'll be available. If not, this session is recorded, right? And so this session will be available to everyone sometime in November once we are finishing editing everything. Ted, want to thank you one last time for your time early on a Wednesday morning. So from the operations team, the entire Startup Boston team, thank you so much.
All right. Thanks very much.
For those of you that are still going to be sitting in on some more of the sessions, please direct your way to the agenda in the top left corner. We have a couple other sessions that are wrapping up as well if you want to catch the tail end of those. And our next round, we're starting at 9:15. So we will see you over there. Thank you so much.